Canada represents approximately 3% of world market capitalization. That means if you wanted to own every publicly traded company in the world in proportion to their actual size, you would put 3 cents of every dollar into Canadian stocks and 97 cents into everything else. The average Canadian equity investor puts approximately 50 to 60 cents of every dollar into Canadian stocks. That is a 17 to 20 times overweight to a market that represents 3% of global wealth creation. And most Canadian investors do not even know they are doing it. It happens naturally because Canadian banks are familiar, Canadian dividends are tax-efficient, Canadian stocks are priced in Canadian dollars, and the TSX has performed reasonably well. But here is what it costs. Over the past decade, the S&P 500 returned approximately 12.5% annually in US dollars, and closer to 14% to 15% in Canadian dollar terms as the loonie depreciated. The TSX returned approximately 8.5% to 9.0% annually over the same period. A Canadian who held 100% Canadian equities versus one who held the global market made a very different amount of money. This video makes the case for global diversification, challenges the home bias honestly and with real numbers, and, crucially, names the one legitimate reason to hold more Canadian stocks than the pure market weight suggests. Because there is one, and it is not patriotism. Home bias, the tendency to invest disproportionately in your own country's stocks, is a global phenomenon. American investors overweight the US, Japanese investors overweight Japan, Australian investors overweight Australia. But the Canadian version is particularly acute because the gap between Canada's share of world markets, 3%, and the typical Canadian allocation, 50 to 60%, is among the largest of any developed market. Why it happens, the 5 drivers of Canadian home bias. Driver 1. Familiarity. Canadians know Royal Bank, Enbridge, and Shopify. They use these companies' products. They see their branches. The familiarity creates a comfort that translates into allocation, even when familiarity has no bearing on future returns. Driver 2. Tax efficiency of Canadian dividends. Canadian eligible dividends receive the dividend tax credit, making them more tax efficient than U.S. dividends outside registered accounts. This is a real, legitimate advantage that pulls Canadian investors toward Canadian dividend stocks. Driver 3. Currency comfort. Canadian investors spend in Canadian dollars. Holding Canadian stocks eliminates currency risk on that portion of the portfolio. When the Canadian dollar weakens, U.S. stocks are worth more in CAD terms. When it strengthens, the opposite. The currency volatility feels uncomfortable, even when it often works in Canadian investors' favor. Driver 4. Broker and advisor defaults. Many Canadian financial advisors defaulted to TSX-focused portfolios for decades, partly due to regulatory familiarity and partly because Canadian bank mutual funds were the dominant product offering. The home bias is partially structural, baked into the product distribution system. Driver 5. Anchoring to recent performance. When the TSX performs well, as it did during the commodity supercycle, Canadian investors extrapolate that performance forward and increase their Canadian allocation. The anchoring bias reinforces the home bias during periods of TSX strength. The concentration problem within Canada, even within the 3% of world markets that Canada represents, the TSX is itself a concentrated, sector-specific index. The top 10 stocks represent approximately 38% of the entire index. The Big Six banks alone represent approximately 20% plus of the TSX. Enbridge alone is approximately 5%. A Canadian investor who holds 60% of their portfolio in the TSX effectively has massive exposure to Canadian banking and energy, and almost zero exposure to technology, healthcare, and consumer sectors at global scale. The case for U.S. stock exposure is not primarily about past returns, though those have been strong. It is about the structural characteristics of the U.S. market that Canadian investors cannot access domestically. Sector diversification. The primary argument. The U.S. market offers Canadian investors access to sectors that are essentially absent from the TSX at meaningful scale. Specifically, technology, Apple, Microsoft, NVIDIA, Alphabet, Meta, Amazon, the companies building the AI infrastructure cycle that is defining the 2020s. Combined market cap exceeds Canada's entire GDP multiple times over. Healthcare and pharmaceuticals. Johnson & Johnson, United Health, Eli Lilly, Pfizer, global healthcare companies with pricing power and demographic tailwinds from aging populations. Largely absent from the TSX. Consumer discretionary at global scale. Amazon, Tesla, Home Depot, Nike. Consumer brands with global reach. The TSX has Canadian consumer names, but none approaching global scale. Innovation companies across all sectors. The U.S. market has been the primary destination for the world's most innovative companies, both domestic and international, for decades. The depth and breadth of the U.S. innovation ecosystem has no Canadian equivalent. Scale and liquidity. The S&P 500 represents approximately $45 to $50 trillion in market capitalization. The TSX represents approximately $3 to $3.5 trillion. The U.S. market is approximately 14 times larger, meaning more liquidity, more analyst coverage, more price discovery, and access to companies at every size and stage of development. The currency effect, a double-edged sword that has mostly helped. Canadian investors who hold U.S. stocks in U.S. dollars receive their returns in U.S. dollars. When the Canadian dollar weakens against the U.S. dollar, as it did significantly from 2013 to 2016 and has generally trended weaker since, the USD returns convert to larger CAD amounts. The Canadian dollar at approximately 72 cents to 74 cents USD in July 2026 means the loonie has depreciated significantly from parity in 2011 to 2012. This depreciation added approximately 1 to 3% annually to U.S. stock returns for Canadian investors over the past decade. A meaningful tailwind. If the CAD strengthens, this reverses. Here is the vault. The one legitimate, financially sound reason to hold more Canadian stocks than the pure 3% market weight suggests. And it has nothing to do with patriotism, familiarity, or dividend tax credits. It is currency matching. You live in Canada. You spend in Canadian dollars. Your mortgage, your groceries, your utilities, your health care, all priced in Canadian dollars. When you retire, you will spend in Canadian dollars. The income you draw from your portfolio will need to be converted to Canadian dollar purchasing power. Now consider a portfolio that is 100% U.S. stocks. In U.S. dollars terms, it performs beautifully. But your spending needs are in Canadian dollars. If the Canadian dollar strengthens significantly against the USD in the years you are drawing down the portfolio, your USD returns by fewer Canadian dollars. The currency mismatch between your asset base, USD, and your liability base, CAD spending needs, creates real financial risk. Canadian stocks, priced in Canadian dollars, naturally match your spending currency. The Canadian bank dividend you receive from Royal Bank arrives in Canadian dollars. The Enbridge pipeline distribution arrives in Canadian dollars. No currency conversion. No exchange rate risk. The income matches the expense. This is the academically rigorous argument for a Canadian overweight. Vanguard's research suggests that approximately 30% Canadian equity is optimal for a Canadian investor. Enough to provide meaningful currency, matching for spending needs, while capturing most of the global diversification benefit. This is why XEQT holds approximately 25% Canadian equity and VEQT holds approximately 30%, both significantly above the 3% market weight, but far below the 50% to 60% typical home bias. The ETF designers knew about the currency matching argument and built it in. The legitimate Canadian overweight is approximately 25 to 35%, not 3%, pure market weight, and not 50 to 60%, home bias. The middle ground captures both the currency matching benefit and the global diversification return. Beyond the investment case, the tax treatment of Canadian versus U.S. stocks differs significantly and affects the optimal account placement for each. Canadian eligible dividends, the tax advantage, dividends from Canadian corporations to Canadian residents receive the eligible dividend tax credit, significantly reducing the personal tax rate on that income. At an Ontario top marginal rate of 53.53%, eligible dividends are effectively taxed at approximately 39.3%, and inside a TFSA at 0. This is a meaningful tax advantage that U.S. dividends do not receive. U.S. dividend withholding tax, the invisible cost. When a Canadian holds U.S. stocks paying dividends outside of an RRSP, the U.S. government withholds 15% of the dividend before it reaches the Canadian investor. This withholding tax applies in non-registered accounts and, critically, in TFSAs. The Canada Revenue Agency does not provide a foreign tax credit for withholding taxes lost in a TFSA. The RRSP exception, under the Canada-U.S. Tax Treaty, U.S. dividends paid into a Canadian RRSP or RRIF are exempt from the 15% withholding tax. This makes the RRSP the optimal account for holding U.S. dividend-paying stocks. The account placement rules for Canadian investors, TFSA, Canadian stocks, eligible dividends tax-free, and Canadian growth stocks, capital gains tax-free. U.S. stocks that pay significant dividends lose 15% to withholding. Inefficient. RRSP, U.S. dividend stocks, no withholding tax under treaty. U.S. index ETFs, like VFV, are particularly tax-efficient here. Non-registered, Canadian-eligible dividend stocks, dividend tax credit. Capital gains taxed at 50% inclusion, regardless of nationality. The practical implication, a Canadian investor holding VFV, 100% S&P 500, in their TFSA is losing 15% of every U.S. dividend to withholding tax, an ongoing, invisible drag that reduces the effective return. The same investor holding VFV in their RRSP pays 0 withholding tax. Moving U.S. ETFs from TFSA to RRSP and replacing them with Canadian ETFs in the TFSA is one of the highest return administrative actions available. The framework, 3 approaches by complexity. Approach 1. The simplest, XEQT or VEQT, and done. XEQT holds approximately 25% Canadian equity and 75% global, U.S. international. VEQT holds approximately 30% Canadian and 70% global. Both are already optimized for a Canadian investor. The currency matching argument is built into the allocation. 1 ETF, 1 purchase, no rebalancing required. For the vast majority of Canadian investors, this is the right answer and all the complexity needed. Approach 2. The split. Canadian ETF plus US ETF in different accounts. For investors with both a TFSA and an RRSP wanting to optimize tax placement. TFSA, XIC, or ZCN, Canadian Equity ETF, eligible dividends completely tax-free. RRSP, VFV, or ZSP, S&P 500 ETF. No U.S. dividend withholding under treaty. This achieves approximately the same allocation as XEQT while maximizing tax efficiency in each account. Approach 3. The tilt, adjusting the Canadian allocation based on your situation. Closer to retirement, spending in Canadian dollars. Tilt toward 35 to 40% Canadian for greater currency matching. Long-time horizon, maximum return focus. Tilt toward 20 to 25% Canadian for greater global diversification. Dividend income focus. Tilt Canadian for eligible dividend tax efficiency. VDY XDV. Growth focus. Tilt US for technology sector exposure. VFV QQC. The answer to the home bias question: the average Canadian investor at 50 to 60% Canadian exposure should reduce toward 25 to 35%, not to 3%. The currency matching argument justifies a meaningful Canadian overweight, not to 50 to 60%. The home bias sacrifices too much global diversification. The 25 to 35% range is where the research points, where the best Canadian all-in-one ETFs are designed, and where a Canadian investor captures both the tax efficiency of Canadian dividends and the return and diversification of global markets. Canada is 3% of world market capitalization. The average Canadian investor holds 50 to 60% Canadian stocks. That is the home bias, and it has cost Canadian investors meaningful return over the past decade by excluding them from the technology and healthcare sectors that drove global wealth creation. The one legitimate reason to overweight Canada is currency matching. You spend in Canadian dollars, your Canadian stocks pay in Canadian dollars, the income matches the expense. That argument justifies approximately 25 to 35% Canadian equity, not 3%, and not 50 to 60%. The tax rules reinforce the strategy. Canadian eligible dividends in the TFSA, U.S. stocks in the RRSP, XEQT or VEQT in a single account does both automatically. The home bias is one of the most common and most costly investing mistakes Canadians make. It is also one of the easiest to fix. One reallocation, one account swap, and you are positioned where the evidence and the research say you should be.